Silver mining stocks have outpaced gold miners so far in 2025, and the gap is wider than most investors expected. The broader silver miners index, tracked by the SEL ETF, has posted stronger gains than the gold miners benchmark, GDX. That divergence is worth paying attention to, because these two groups usually move together. Both are sensitive to bullion prices, mining costs, and investor appetite for risk. When they split, something specific is driving it. In this case, two things are working in silver's favor at once. First, silver is a monetary metal. When investors get nervous about inflation, dollar weakness, geopolitical risk, they buy silver alongside gold. That safe haven demand has been running hot in 2025. But silver also has a second engine that gold does not: industrial demand. Solar panels, electric vehicles, advanced electronics, all of these are heavy consumers of silver. Optimism around green energy build-out has kept that industrial demand narrative alive through the first half of this year. Both engines firing at once has pushed silver prices up sharply. Second, silver miners carry significant operating leverage. Most producers have relatively high fixed costs. When silver prices rise, those incremental gains drop hard to the bottom line. Profits improve faster than the metal price itself. That leverage draws growth-oriented and speculative investors when sentiment turns positive, and it amplifies gains in the miner stocks beyond what you'd see in the metal alone. Gold miners, by contrast, have had a more complicated run. Gold prices have stayed well supported. Central bank buying, dollar uncertainty, and geopolitical risk have all helped. But the cost environment for large gold producers remains elevated. Labor, energy, and equipment expenses have kept margins under pressure at many major operations. Gold's price strength hasn't translated cleanly into earnings growth. That's capped how much the miners have rallied relative to the metal. The open question is whether the conditions that favored silver miners hold through the second half of 2025. Silver is more volatile than gold in both directions. A slowdown in industrial demand signals a stronger dollar, or a broader shift away from risk assets could close the performance gap quickly. The data suggests that gap remains fragile. The key numbers to watch: the gold to silver ratio, industrial output data from major manufacturing economies, and any shifts in Federal Reserve policy that move the dollar. These three inputs carry direct implications for where silver miners head from here. If you're tracking metals markets right now, the silver to gold miner divergence is one of the cleaner signals available, not a reason to chase, but a useful indicator of where risk appetite and industrial confidence actually stand.